Hello friends, let us come to this amazing topic Accounting Standard 23. Accounting Standard 23 is called Accounting for Investment in Associate in Consolidated Financial Statement. So the name of the standard is quite lengthy. So let us understand what it means. It means we have to learn accounting for investment in associate. There is a special type of investment, that is investment in associate, but it is not subsidiary, it is not joint venture, it is associate in the consolidated financial statement. This standard is applicable, as the name suggests, only and only in the consolidated financial statement. In the separate financial statement, accounting standard 13 will be followed. Okay. Now, this standard is important because it talks about a special kind of investment, that is investment made in associate. Before we go further, let us understand why this standard is important. Who are associates? Who are associates? Or let us say who is associate? So as per the standard, associate means entity where we exercise significant influence. Where we exercise significant influence. Significant influence means you are able to participate in decision making. Significant influence means power to participate. All this is written in the book, power to participate in decision making process. If you understand the concept, then we can move further. And usually the stake is more than 20% in equity. That is, you are holding 20% or more in the equity, but less than 50%, but less than or equal to 50%. Why it is not more than 50%? Because with more than 50%, it will become your subsidiary, and if it becomes your subsidiary, then accounting standard 21 consolidated financial statement would apply. Okay, so associate means entities over which we have significant influence, where we usually hold 20% or more share in the voting power, where we have the power to participate in their financial and operating policy decisions. So let us say this is an entity which we will call, for example, X Limited, and here you are an investor. You have invested your hard-earned money. Oh, why he's dancing? You are an investor. You invested your hard-earned money in this company. Suppose you invested 20 lakh rupees in this company, and like you, many investors have invested 20 lakh rupees in this company. This company have invested in share capital of Y, big amount. Let us say they have invested 200 crore rupees in Y. So in the books of X, investment in Y Limited will appear in separate financial statement, and the amount invested is, for example, 200 crore. So if we are only following AS 13, if you are following only AS 13 and there is no accounting standard 23, then what will happen? This investor will get the annual report of X every year end, and it will be able to see only one line item in the balance sheet that will say investment in Y Limited 200 crore. This investor will not be able to understand the performance of Y Limited, because accounting standard 13 does not require you to show the performance of associate. It only says value investment at cost, and if it is a long term investment and there is a permanent decline, then make impairment or make reduction in the value of the asset, otherwise continue to carry the investment at cost. And if at all Y Limited pays dividend, then in the P&L account of X you will be able to see dividend from Y. Otherwise you will not have any information about Y Limited. Is it good for the investor or bad for the investor? Look at the question from this: who has invested in X and that money is not used by X, that money is actually used by Y because the money got transferred to Y. So as an investor you are interested in understanding the performance of Y Limited also. Hence this standard is important. So under this standard, what will happen? The performance of Y will get reflected in the consolidated financial statement of X, and that will help the investors of X to understand how the associate companies are performing. Nowadays many companies work through the associate companies where they make a huge investment, and as an investor I am also supposed to understand the performance of associate, because my money is not actually used in X, that money has actually got transferred to Y. So if you have understood the reason for preparing a special accounting or doing special accounting for investment in associate, then I will go further. An enterprise, now this standard is only having one drawback. And what is the drawback? That the standard is applicable only if the company is preparing CFS. So X Limited must have a subsidiary. If X Limited has a subsidiary, it will prepare CFS. Consolidated financial statement, and then AS23 is applicable. Now your question can be, if X Limited does not have subsidiary, then what? If X Limited does not have subsidiary, it won't prepare CFS. Then what? AS23 is enjoy not applicable. AS23 is not applicable. So one has to also ensure that if a company wants to follow AS23, it can follow only if it has a subsidiary. That means it should have a consolidated financial statement. If it is not preparing consolidated financial statement, then this standard AS23 is not applicable. This standard became effective from 1/4/2002, and it is not applicable in separate financial statement. In separate financial statement, accounting standard 13 is applicable, which you have already studied. Okay. Parent in its separate financial statement will follow AS13. So in SFS, separate financial statement, AS13 will be followed. If entity is preparing CFS, then AS23 will be followed for associates. So these are the applicable standard for associates. In CFS, AS23 is applicable. In SFS, AS13 is applicable. The objective of this standard is, as I have told you, to help the users to understand the performance of associate better. Hence, they have given the principle and the procedure that the entity will follow for recognizing in CFS the effect of investment in associate. How the investment in associate is going to affect the balance sheet and the profit and loss. With the help of AS23, we can understand the performance of associate in a better manner. General knowledge question. Advantages of following AS23. As an investor, the one who is putting his money in a corporate, in an entity, he will be able to assess the associate performance in a better manner. He will be able to measure return on investment in a better manner. He will be able to see how much investment was made by the company, how much investment in associate was made, and how much is the profit from associate earned by the company. That will help him to calculate return on investment in associate. If it is very good, the investor would be happy. But if it is very low, the investor will not be happy. Investor will ask questions to the management, the justification for making such investment in associate where the ROI is very low. Third reason or third advantage of following AS23, it helps us to have a meaningful analysis of the performance of the associate. In the absence of AS23, we would not have understood the genuine performance of the associate. We would have only got one line item in the separate financial statement, and that is investment in associate at cost, and we would have got one line item in P&L account, dividend received from associate. And because of that, AS23 improves the financial reporting. It helps in having proper reporting, because as an investor we should get enough information for decision making, and if the reporting is properly done, investor can take a more informed decision. Now my standard begins. Who is an associate? Paragraph number 4. Who is an associate? An associate is an enterprise in which the investor has significant influence. Significant means not simple. It is something where you will participate in the decision making process of that company, and that is where you can influence that company significantly, and that other company should not be a subsidiary, because if it is a subsidiary, then AS21 will apply, and it should not be a joint venture, because if it is a joint venture, then AS27 will apply. Hence, the other entity over which we should have significant influence should not be subsidiary or a joint venture also. Then it is called an associate. So how do I test an associate? I will check whether we have significant influence and the other entity is not our subsidiary or joint venture. Okay. So the two conditions required for the other entity to be our associate is we should have SI, significant influence, and second, the other entity should not be subsidiary or joint venture. So these are the two conditions required for other entities to be our associate companies. We should have significant influence and the other entity should not be our subsidiary or joint venture. Now next question you are asking is, what is significant influence? What do you mean by significant influence? In the context of two entities, significant influence means the power to participate. Power to participate. So you will also be one of the decision making persons. Okay. You are not taking the decision, but you are participating in the decision in the financial and operating policy. Financial policy also, operating policy also, or both. So you have the power to participate in financial and operating policy decisions of the investee, but you don't have control over this policy. You don't have control, because if you have control, ES21 will apply. You can participate, but you are not able to control. You do not have control over these policies. Like for example, you are a student, parent, have control, but we are teachers. We have only significant influence over you. We can influence you, but we can't control. But parents can control. Parent will say, if you don't study, we will not give you mobile phone, we will not give you pocket money, and then you have to follow their instruction. But we as a teacher, we can only guide you that you should study so that you will perform better in the exam, you will become a good person, you will get a good career opportunity. That is called only significant influence. Same thing in case of corporates. If they are able to control the other entity, the relationship become parent and subsidiary. If they are able to exercise significant influence, the relationship becomes investor and associate. Okay. So how can you obtain significant influence? Significant influence can be by share ownership, which is usually the case, and especially from exam point of view, share ownership is the test of significant influence. So the share ownership should be between 20 to 50%. 20 to 50%. If you are holding 20 to 50% share, then it is presumed that you have significant influence. Why we have not taken more than 50%? With more than 50%, the other entity becomes your subsidiary, or it can be by way of statute, that is law. The law may give you significant influence. For example, State Bank of India may influence other state banks by law, or it can be agreement. For example, managing director of a company can have significant influence because of the agreement between the company and the managing director, because he is given so much of power that is able to exercise significant influence. But we would be mostly concentrating our effort on understanding significant influence through share ownership. Now there are two important points. This is a 20% line, 20% border line. If you are holding more than 20% share of another company, directly or indirectly through subsidiaries, either you are owning directly or you plus your subsidiary are holding 20% or more share in the voting power. Okay, more than 20%. It is assumed that you have significant influence. It is assumed that you have significant influence unless proved otherwise. Sir, what is unless proved otherwise? But if you can prove that even though you are holding 20% or more share, but you are not exercising significant influence, then you are not supposed to follow AS23. For example, you are a passive investor, an investor who does not participate in financial and operating policy decision. He is only happy with the dividend that he receives. He does not attend any board meeting or any committee meeting or anything which have financial and operating policy decisions involved. Then this passive investor can say that I do not exercise significant influence, and the standard says okay, enjoy, then you are not required to follow AS23. And another thing is that suppose this is a 20% line, you are holding less than 20%. An investor is holding, a company is holding less than 20% share in other company, then it is assumed. What it is assumed? No significant influence unless proved otherwise. Oh, unless proved otherwise means suppose a company is holding 19% share in another company. Company is holding 19% share in another company, but it is able to also participate in financial policy decision or operating policy decision or both. With 19% holding, you are able to appoint one board member. With 90% holding, suppose you are able to appoint one board member. A board member is a person who participates in the financial policies of the company, and therefore this company with even less than 20% share in the voting, it will be following accounting standard 23. So then what is the purpose of this standard 20% line? This 20% is not a very hard and fast rule. With more than 20%, a passive investor need not follow AS23, and with less than 20%, an investor who participates in financial policy decision can follow AS23. Okay. Now next paragraph is, suppose in a company X Limited, we have one A Limited and another investor B Limited. In X Limited, A Limited has invested 60% of the total shares and B Limited has invested 40%. So A has control over X Limited. Can presence of a party who is having control over X Limited prevent B Limited from exercising significant influence? If in a company somebody is holding majority stake, does it mean other stakeholders can never have significant influence? The answer is no. B can have significant influence even though A Limited is having a majority stake, and B Limited will apply AS23. So this is the meaning of this line. A substantial or majority ownership by another investor does not necessarily preclude an investor from having significant influence. So B has significant influence even though A may be holding more than 50% share. Now the question is, how do I check for significant influence? How do I know that significant influence exists? So the standard has given you some examples. 5 examples they have given you. Examples relating to existence of significant influence. Remember, these are examples. It is not an exhaustive list. Anything over and above this also you find can also be an indication of significant influence. One simple test is representation on the board of director or corresponding body of the investee. That means if you are able to appoint one or more board members, you are able to have significant influence, because board takes financial and operating policy decisions. So you will be able to participate in the board meeting. Second is, you are participating in policy making process of the other party. The other party, whenever they take policy making decision, you are entitled to participate in those policy making process. You are having significant influence. The third example is material transactions between investor and investee. Material means here significant. A and B are two companies. B buys 80% of raw material from A, and A is also holding 20% share in B. A is holding 20% in share in B. B buys 80% of raw material from A, which means A is in a position to influence B because of material transactions between the two. Another example is interchange of managerial personnel. A is holding say 20% share in B, and A's senior managers, A's senior manager of A are deputed in B. That means they are working in B for some work, for some project. In short, A is able to influence B because their key employees are actually now deputed in B in whatever capacity. So interchange of managerial personnel is also an indication of significant influence. Next is provision of essential technical information. A is holding, let's say, 20% share in B. A has provided technology required for B's business. B depends on A for its technology requirement. So A is in a position to influence B because A provides technology service, and therefore we will say significant influence exists. Let us take one example 1 and example 2 for better understanding of significant influence. Are you ready? Yes. X Limited holds 6% shares in Y Limited. Z Limited holds 8% share in Y. What is the relationship between X and Z? Z is a subsidiary of X. Now the important line, Z Limited virtually takes part in most of the operating and financial decisions of Y. Z Limited takes part in virtually most of the operating and financial decisions of Y. So the question is, what is the question? Question is whether X Limited has significant influence over Y. Question, write down whether X Limited has significant influence over Y. Whether X Limited has significant influence over Y Limited. X is holding 6, Z is holding 8. Together they are holding 14%. It is less than 20%. But still, Z, which is a subsidiary of X, is able to participate in most of the policy making process. in most of the operating and financial decisions of Y. Can I conclude that X Limited is in a position to exercise significant influence over Y? The answer is yes. 20% is not a necessary condition. X Limited has significant influence over Y because it is able to participate in financial and operating policy decisions through its subsidiary Z. Through its subsidiary Z. It is able to participate in financial and operating policy decisions through its subsidiary Z. Then you write down one more line right here, one more line. It does not matter that it holds, it does not matter that it holds less than, it does not matter that it holds less than 20% share in voting power. It does not matter that it holds less than 20% share in voting power. It does not matter that it holds less than 20% share in the voting power. So if you write this answer like this, you will get full marks. It does not matter that it holds less than 20% share in voting power. So that was my example number 1. Now we'll take one more example. Shiva and Parvati Limited holds 15% equity share in Ganesha Limited. Same problem, but here it is 15% each. So total 30%. And who is Parvati? Parvati is the subsidiary of Shiva. Like the previous question, Shiva and Parvati together they are holding 30% share in Ganesha Limited. Is Ganesha Limited an associate of Shiva Limited? What is your answer? Yes or no? The answer is yes, unless it can be proved otherwise. Write down unless proved otherwise. Unless proved otherwise. Because with more than 20%, if they are not participating in financial and operating policy decision, then we will say that there is no significant influence and hence there is no associate relationship unless proved otherwise. Next is the definition of control. Right here, refer AS21. In this chapter, we are not required to discuss about control. In this chapter, we are not required to discuss about control. Sir, why? Because this chapter is about significant influence. Still, the standard has given one paragraph. I will read. It was already explained in AS21. Control means ownership directly or indirectly through subsidiaries. Directly, that means yourself. Indirectly means through subsidiaries of more than half of the voting power of an enterprise. That is one way to exercise control when you get more than 50% share in voting power. But there is another way of exercising control, and that is controlling the composition of the board of directors. Controlling the composition of the board of directors or corresponding governing body so as to obtain economic benefit from its activities. That means if you are able to control the board of directors or governing body, then also it is assumed that you exercise control over the other entity. This was discussed in detail in Accounting Standard 21. There are two ways of acquiring control. One, through voting power, where it should be more than 50%. Second, control over the composition of board of directors. That means you are able to appoint majority of the board members. That is control. Okay. So today we'll take a break here. We'll continue in the next lecture. Hello, good morning friends. Let us start this chapter again. Our topic is Accounting Standard 23, Accounting for Investment in Associate in Consolidated Financial Statement. So please come to paragraph number 8, Equity Method of Accounting. So we have discussed that this standard is applicable only if the enterprise is preparing consolidated financial statement. If the enterprise is preparing consolidated financial statement, then AS 23 is applicable with respect to associate. Now, associate is a special kind of investment where we are having significant influence. So the standard wants that the user of financial statement should get more information about the performance of the associate. So with that objective, they have designed the standard like this so that you will be able to get the performance of the associate better. The method of accounting to be used for the purpose of consolidation would be equity method of accounting. So one thing you will note down or remember, under AS 23, the method of accounting for investment in associate is called equity method of accounting. So what is equity method of accounting? Let us see. It is written nicely in your book, point by point. I will also explain to you point by point. It is a method of accounting whereby the investment is initially recorded at cost. When the investment would be bought, it will be initially recorded at cost. For example, let us say investment was purchased for 1 lakh rupees. Investment was purchased for 1 lakh rupees. So 1 lakh is the cost. And then we will identify any goodwill or capital reserve arising at the time of acquisition. What is the meaning of this line? Identify any goodwill or capital reserve arising at the time of acquisition. It means we will calculate goodwill or capital reserve, which is the difference between cost of acquisition minus share in net asset of associate. In Accounting Standard 21 also we have seen goodwill is equal to cost of acquisition minus share in the net asset of subsidiary. Here we will call it change in the net asset or share in the net asset of associate on the date of acquisition. On the date of acquisition. If cost of acquisition is more than the share in net asset, we will call it goodwill. For example, cost of acquisition is 1 lakh, share in net asset of the associate. Now, how do you compute the net asset of the associate? Net assets of associate can be calculated in two ways. Either you will take assets minus liabilities, or the second method is to take equity share capital plus reserve and surplus from the balance sheet on the date of acquisition. Let us say equity share capital is 1 lakh, reserve and surplus is 3 lakh. So total net asset is 4 lakh. Total net asset is 4 lakh. Cost of acquisition is 1 lakh. And let us say the investor has acquired 20% share in the associate. So share in net asset will be 4 lakh into 20%. That comes to 80,000. So this difference will be called goodwill. 20,000. This difference will be called goodwill of 20,000. Why it is called goodwill? You have paid more than the share in the net asset acquired. So this extra amount that you are paying is for goodwill, because you are getting a stake in a business, okay, and you will be able to enjoy the profits of that business. So therefore there is a goodwill involved. Otherwise it can be like this also. Suppose cost of acquisition is 1 lakh, share in the net asset is, let us say for the purpose of discussion, 1,20,000. So this difference is called capital reserve. And positive difference will be called goodwill. Capital reserve means you have paid less, you have got more. Paid less, got more. So there is a gain on acquisition indirectly. You are benefiting from acquisition by 20,000. So we'll call it capital reserve. Now how do I present it? We have to identify any goodwill or capital reserve. So I will write here in bracket, if it is goodwill, I will write includes goodwill rupees 20,000. Or if it is capital reserve, I will say this 1 lakh includes capital reserve, say 20,000. So this is my point number 2. You have to identify any goodwill or capital reserve at the date of acquisition. Goodwill is the difference between cost of acquisition and the share in the net asset of the associate on the date of acquisition. Capital reserve is, if you are getting a negative answer, then we will call it as a capital reserve. Now after that, what you will do, every year end, every reporting date, you will calculate what is the profit of the associate multiplied by your share, and investment will be increased to that extent. Meaning, suppose associate profit after acquisition is, let us say, 5 lakh rupees. So what is investor's share in that? Let us say investor is holding 20% stake in the equity of the associate. So 20% into 5 lakh, that is 1 lakh. So what I'll do, I will increase the carrying amount of the investment by 1 lakh by writing a note, add share in post acquisition profit, add share in post acquisition profit of associate, add share in post acquisition profit of associate. So that will make it 2 lakh. All this is happening in the consolidated financial statement. And where is the second effect? The second effect will be given in consolidated P&L account. The second effect will be given in consolidated P&L account. So if you want to understand by way of a journal entry, the journal entry for the above transaction would be like this. If the associate makes profit, investment in associate account debit 1 lakh to consolidated P&L account 1 lakh. In consolidated P&L account, you are going to add 1 lakh or credit 1 lakh. This is a memorandum journal entry. there is no such entry passed. There is no such entry passed in reality, because associate book is different, your book is different, and we do not pass journal entry for consolidated financial statement. That was explained to you earlier also. So this will increase the carrying amount of investment. So what is the benefit of that? As and when the associate will make profit, your carrying amount will keep on increasing. Investor will be able to see, the users of the financial statement will be able to see that yes, the associate is making profit. And similarly, if the associate is incurring losses, we are going to reduce our share in the losses in associate by reducing the carrying amount of investment. By reducing the carrying amount of investment, we will be able to show to the investor that yes, the associate is incurring the losses. Okay. So what is my next adjustment? Let me first erase this, because this standard is very short, simple, nothing great. Every time associate makes profit or loss, you will have to increase or decrease the carrying amount of investment with a corresponding effect in the consolidated profit and loss account. And the same point is written here: the consolidated statement of profit and loss reflects the investor's share of the results of the operation of the entity. So the combined interpretation of these 2 points is, if the associate makes the profit, the effect will be given investment in associate debit to consolidated P&L account for investors share only. The entry will be passed for investors share only. The entry will be passed for investors share only. Okay. And in case of loss, please reverse the entry. Please reverse the entry in case of losses. Is it right? Is it understandable? Now next meaning is, what is equity? Equity means, the definition of equity as per the standard is the residual interest in the asset of the enterprise after deducting all its liability. And to put it in simple words, equity would mean asset minus liability, or equity share capital plus reserve and surplus. So as and when, first when you are acquiring the investment, you will do this calculation for finding goodwill or capital reserve, and subsequently whenever the equity of the associate will change, whenever the associate's equity will change, we will calculate our share, that is investor share in that, and adjust the carrying amount of investment with a corresponding effect in P&L account usually, or sometimes in other reserve. Now we'll come to paragraph 10. One more time, there is a small repetition, so I will not repeat again, but whatever extra point will come, I'll explain. An investment in an associate is accounted using equity method. This method is called equity method. That is where the investment in carrying amount of the investment will keep on increasing or decreasing as the associate is making profit or incurring losses. So we will follow equity method of accounting from the date the investment is treated as associate. First point explained to you: day one investment will be initially recorded at cost. On day one, we will identify goodwill or capital reserve. Okay. And on acquisition of investment, any difference between cost of acquisition and investor's share of the equity of the associate is described as goodwill or capital reserve, as the case may be. So I will again explain how to compute goodwill or capital reserve. Cost of acquisition minus share in net assets of associate on date of acquisition. Okay, let us call it A, let us call it B. If A is greater than B, it is goodwill. If B is greater than A, then it is capital reserve. Example already given in our previous paragraph number 8. Is it right? So goodwill will come when cost of acquisition is more than share in equity. Capital reserve will come when share in equity is more than cost of acquisition. Now, how to present goodwill or capital reserve? Very, very important paragraph. Goodwill or capital reserve arising on the acquisition of an associate, should be underlined. I have also underlined, you can also underline. It's already underlined in the book. Should be included in the carrying amount of investment in the associate. Should be included. It should remain included in the carrying amount of investment, but should be disclosed separately. Now this is a very confusing line. What are they trying to say? Cost of acquisition is 1 lakh, let us assume, and we have computed and found that goodwill is 20,000. So we will write it is included in the carrying amount. 1 lakh includes goodwill of 20,000, but it has to be disclosed separately. So for disclosure purpose, we will write includes goodwill equal to rupees 20,000 or includes capital reserve. So this will just give an idea that while acquiring this investment, we have paid 20,000 rupees in excess of the share in net asset. Okay. In accounting standard 21, goodwill was presented as a separate line item in the balance sheet. If you have done AS 21, you will recollect goodwill was appearing as a separate asset in the asset side of the balance sheet. Here goodwill will not appear as a separate asset in the balance sheet. It will be included in the carrying amount, but it will be disclosed separately. So it's only a disclosure requirement here. We are not going to show goodwill separately. Okay. And now subsequently, after the date of acquisition, suppose date of acquisition is 1/4/2005 and then year ending date 31st March 2006. In this post acquisition period, first check how much profit or loss the associate has earned or incurred. Compute share of the investor in that and increase the carrying amount or decrease the carrying amount of investment with a corresponding effect in the consolidated profit and loss account. With the corresponding effect in the consolidated P&L account. So I have already explained and I don't mind writing one more time. The memorandum journal entry for recording the share in the profit of associate will be if the associate makes profit. Investment in associate, this is for understanding, means if I am debiting investment in associate, the investment value will increase to consolidated P&L account, and consolidated profit and loss account will show the share in profit. Suppose the associate suffers loss, then we are going to record our share in loss, consolidated P&L account debit to investment. Investment value will reduce. Investment in associate. Share of loss recorded. So this will show you every time, every reporting date, we have to keep on passing these entries. And then next point, it says adjustment to the carrying amount may also be necessary for alteration in the investor's proportionate interest in the investee arising from change in investee's equity that may not have been included in the profit and loss account. Then your question would be, what is I need to explain what is this point. Sometime there may be some gain or loss which may not be recorded in the profit and loss account of the associate, which may have been recorded directly in the reserve. Like for example, revaluation of fixed asset. Revaluation of fixed asset, AS10, students will remember. When fixed asset is revalued upward, the entry passed is PPE account debit. This is the effect of that upward revaluation to revaluation reserve. This doesn't go through profit and loss account, but it has increased the equity of the associate. Okay. Or another example could be foreign exchange translation gain or loss. Accounting standard 11 deals with foreign exchange gain or loss. Sometimes there may be a direct credit. Sometimes there will be a direct credit in the foreign exchange translation reserve, foreign currency translation reserve, which may not be routed through P&L account. So in that case, what I am going to do, and one more example, sometime when there is an amalgamation, that time also there may be some reserve created directly without routing through profit and loss account, like capital reserve. Which standard deals with amalgamation? The student should note down AS14. Okay, so under AS14, if you acquire other company, cost of acquisition is less than the net asset acquired, it gives rise to cap reserve. So these are the example of revaluation reserve, foreign currency translation reserve, capital reserve, which directly go and get adjusted in reserve and surplus. They are not routed through profit and loss account. So in that case, what I'll do, in the books of investor, we are going to compute the proportionate share. We are going to compute the proportionate share and pass the adjustment entry. How do I pass the adjustment entry? So you can write here if you have space, or keep writing in the books or notebook. Let us say the associate has revalued the asset upward by 5 lakh. Our share is 20%. So I will write 20% of revaluation reserve created in the book of associate, and this time I am going to credit revaluation reserve. Same reserve, name of the reserve will be same. Whatever name is given in the books of associate, same reserve. So this time the second effect may not be in the P&L account. The second effect may be in the revaluation reserve. So the summary of this paragraph, this discussion is that if there is any increase or decrease in the equity of the associate, which is not routed through P&L account, even the effect of that will be given in the consolidated financial statement of the investor. Now, very important paragraph is treatment of unrealized profit and losses. If you have studied AS21, consolidated financial statement, then you will understand it easily. Let us say we have investor and we have associate. cost is 100, cost of inventory sold is 100 to investor, but sold for, let us say, 150, sold for 150, and also assume investor holds 20% share in the associate. So investor has made a profit of 50 rupees in this transaction. Investor has made a profit of 50 rupees in this transaction, but associate has not yet sold the inventory. Inventory is still unsold. In the premise of associate, the inventory is still lying, it is not yet sold. So what we are going to do, out of 50, we are not going to realize the profit to the extent of investor share. Okay, so unrealized profit will be unrealized profit will be 50 into 20%, that is 10. So this is called unrealized profit. Now this transaction can be either way. This transaction can be either way. What is either way? It means the transaction can be from associate to investor also. It can be from investor to associate or associate to investor. Doesn't matter. Your answer will be same. Your answer will be same. Let us say we change the example. Cost to associate 100 rupees. Selling price is 150. Inventory is unsold. Answer is same. The unrealized profit will be 10 and it will be eliminated from investment. So what is the journal entry will pass? Elimination of unrealized profit. Because the profit is not yet realized, we need to remove it from the books. Student has to study AS21 consolidated financial statement also before this standard. Otherwise, you will not be able to understand. When the profit is not yet realized, it is better to eliminate it. Otherwise, the investor can book higher and higher profit only by transacting with the associate. So the standard says you are also a 20% owner in that associate. So till the associate sells the stock or till the investor sells the stock, 20% profit will not be treated as realized. So while preparing CFS, this needs to be eliminated. Profit needs to be eliminated by passing the entry consolidated P&L account to investment in associate. Elimination of unrealized profit, because the profit is not yet realized. Profit will be realized when the inventory will be sold to third party. So till the inventory is sold by investor to the third party, or in the earlier example by associate to third party, profit is not realized, and we are going to reduce investment and we are going to reduce the profit to the extent of investor's share only. To the extent of investor's share only. The treatment in AS21 was different. In AS21, we used to eliminate the entire unrealized profit. Here we are going to eliminate only the investor's share in that unrealized profit. Okay, so this is about profit. Okay, so first read this note. In using equity method for accounting for investment in an associate, unrealized profit and losses resulting from transaction between investor or its consolidated subsidiaries and the associate should be eliminated to the extent of investors' interest in the associate. So this point is worth noting. The profit will be eliminated to the extent of investors' interest in the associate. Okay. What about unrealized losses? Unrealized losses should not be eliminated if and to the extent the cost of transferred asset cannot be recovered. If and to the extent the cost of transferred asset cannot be recovered. Now, this is a concept of prudence. Concept of prudence. Unrealized loss should not be eliminated, but there is a condition: if and to the extent the cost of transferred asset cannot be recovered. If and to the extent the cost of transferred asset cannot be recovered. What do you mean by this? So there are two parties again: investor, associate. And let us say cost is 100, sold for 80. Cost is 100, sold for 80. So there is a loss of 20. Investor is holding 20% stake in the associate. Now there are two cases possible. Case 1. Case 1 is the market value of inventory was 110. Market value of the inventory was 110. Market value of the inventory was 110, but you have sold it to your associate company for 80 rupees only. So this is not a normal business transaction. It is not a normal transaction because the market value was higher, but you have sold it for a loss. So it is a bogus transaction. It's a bogus transaction. I will call it bogus. Standard doesn't say, because the objective is to book the loss. So this is, in that case, you will have to compute unrealized loss. Unrealized loss will be 20% of 20 loss, 4. And you have to eliminate it. And you have to eliminate this loss. You have to eliminate this loss. How do I eliminate this loss? By passing the entry investment in associate account debit to consolidated P&L account. So this is called elimination of unrealized loss. But now I'm going to change the example. And the example would be case 2. I hope you have noted. So I need to change. Whatever you want to write it down, you write it down along with me. Okay? Or maybe those who are watching in video mode, you can pause and you can note it down. Suppose case 2, market value of the inventory is rupees 80. Market value has gone down. The market value itself has gone down, and that is why investor had to sell it to the associate for 80 rupees. So in this case, the loss is genuine. loss is genuine, no need to reverse the loss. No need to reverse the loss because the loss is genuine. Because cost of transferred asset cannot be recovered. There is a genuine fall in the market value. Even if you would have sold in the market, you would have sold it for 80 rupees. So you have sold it to associate for 80. Loss is genuine. No need to reverse the unrealized loss if the loss is genuine. Okay. So we have made a small summary for this. Unrealized profit. Deduct from carrying amount of investment with corresponding adjustment to P&L account. Entry I have told you. Then unrealized loss entry also I have told you. Add to the carrying amount of investment with a corresponding adjustment to profit and loss account. Now we'll take one question which is already printed in the book. You will have to do fill in the blanks work. Okay. And you have to answer how much would be the unrealized profit or loss. You have to answer how much would be the unrealized profit or loss. So I hope you are ready to participate in the discussion. I will give you time to think. First line, write down investor is A, associate is B, investor's interest in associate 25%, and seller is A, buyer is B. This will not affect your answer in AS23. In AS21, it made a difference because it was upstream and downstream transaction. But in this chapter, as per the standard, it doesn't matter whether the investor has sold to associate or the associate has sold to the investor. Up to this we have printed in the book. Now write down the cost price of the seller 1000, sold for 12,000. If it is sold for profit, we don't have to check the realizable value. If it is sold for 12,000, which is above the cost, means it is at profit, we don't have to check the realizable value. Now write down percentage stock held by the buyer. Percentage stock held by the buyer is 40%. You will have to compute unrealized profit or loss. So understand, the answer here will be 12,000 minus 10,000. 2,000 is the profit, but 40% stock is unsold. What is sold, profit will be recognized. We are talking about unrealized profit on unsold stock 40% and further multiply by investor's interest in the associate. So that comes to 200. So please write 200 there, and if you want to write the working note of that, you can write in the book or in the notebook, wherever you please. Is it right? Next, I will take case number 2. Cost price, write down cost price 40,000, selling price 45. So it is sold at a profit. 45,000 minus 40,000, sold at a profit. And unsold stock is 80% into 80% and multiply by share of investor in associate 30%. So 5,000 into 80% into 30%. How much is that? That is 1200. This is the working of 1200. If you are interested, if you are a genuine student, good student, you will note down. Others will only watch the show as if there is some program going on. Now, these two, case 1 and case 2, were based on profit. That was easy. But this next case is based on losses. Let us see. Cost is 10,000, sold for 8,000. So there is a loss. And what is the realizable value? 8800. Percentage stock held 40%. Market price is 8800, but you have sold for 8000. Total loss is 2000. Can you see that? Total loss is 2000. And if I compare these two numbers, the loss should have been 1200 only. How much is the genuine loss? Genuine loss is 1200. How much is bogus loss, extra loss they have tried to create? Extra loss, additional loss they have tried to create is 8800 minus 8000. That is 800 is the bogus loss, artificially created loss. 1200 is genuine. I understand market value has gone down to 8800, so 1200 would have been the loss, but you have created 800 extra loss multiplied by unsold stock and multiply by percentage share. So that comes to, do the calculation and check, 800 into 40%, 320 into 25%, so minus 80. And one last case, 10,000, 8,000. 10,000, 8,000, the loss is 2,000. The loss is 2,000. Market price is 11,000. So the entire loss is bogus loss. Entire loss. And the last case, entire loss is wrong. 2,000 rupees loss into 40% into 25%. Here the entire loss is just created to reduce the profit in the books. This loss is bogus. 2,000 rupees bogus loss. We are going to eliminate it. We are going to eliminate it. Is it right? Any question on this? Please write down the working also. This 2000, if you are interested how it has come, you can make a note here, 10,000 minus 8,000. And you put 4 asterisk mark here. Right? Okay, come back to this wonderful topic. Any question on this? So I'll just explain the last 2 points again. Here my cost is 10,000 but sold for 8,000, whose market value is 8,800. So we could have sold at 8,800, that was genuine, but we have sold it for 8,000. So 800 rupees is the additional loss which the seller is trying to create, and therefore we need to eliminate. Whereas in the last case, even though the market value is more, it was sold below that. So this entire loss is just their planning to reduce the profit, and we will eliminate the entire 2000 into 40% into 25%. Now come to next discussion, dividend received from associate. Associate will pay dividend, investor will receive. Okay. Now the student of our course has should have the basic knowledge. Suppose we are in the books of associate. So I am going to ask you question. What entry do they pass when they declare the dividend? When they declare the dividend, they pass the entry profit and loss account debit or retained profit account debit, whatever you call it. In the books of associate, for declaration of dividend, to dividend payable. to dividend payable. Being dividend payable, and then they will pass the entry, dividend payable account debit, to bank account, being dividend paid. These are the two entries to be passed. One is for creating a liability when dividend is declared, and second is entry for payment when dividend is paid. Where are you passing these entries? You are passing these entries in the books of associate, but we have to apply accounting standard 23 in the books of investor. In the books of investor, in CFS, whenever the dividend will be received, now you look at these entries. What is the effect of this entry? The effect of this entry is that the associate profit and loss account is reduced. If associate profit and loss account is reduced, or if I look at the bank balance is reduced, it means associate net asset has got reduced. It means associate's net asset has got reduced. So what is the treatment? As we discussed, the basic concept of the standard is when the associate net asset increases, we increase the carrying amount of investment, and therefore when the net asset decreases, we will reduce the carrying amount of investment in the books of investor. So in the CFS, when they will receive the dividend, bank account debit, this is happening in CFS, to investment in associate, account. Okay, being investment balance reduced on receipt of dividend. Okay, it's written here, against carrying amount of investment, as share of profit in associate is adjusted by increasing the carrying amount of investment. When they earn the profit, the net asset increases. We increase the carrying amount. Now when they are paying the dividend, the net asset reduces. We will reduce the carrying amount of investment. So this entry you will pass in CFS, consolidated financial statement, right? So that was about, I hope you have noted down. What good student will do, they will note down. Okay, they will note down entry in the books of investor in CFS, the treatment for dividend received. Okay, share in profit is added. Whenever they pay dividend, net asset reduce the carrying amount of investment. Next point, when the associate has made a provision for proposed dividend, that is only the first entry, provision for proposed dividend, entry in the books of associate. In the books of associate, sometimes they will pass an entry P&L account debit to proposed dividend, being dividend proposed, but dividend is not yet paid. So in the balance sheet, proposed dividend is appearing on the liability side. Investor share should be computed without taking into consideration the proposed dividend. Very important, because the dividend is not yet paid. Only a provision has been made. The bank balance has not reduced. The net asset has not reduced. So while computing the profit of the associate, ignore this entry. For example, profit made by the associate is 1 lakh, dividend proposed is 50,000, balance in P&L account is 50,000. I will take 1 lakh rupees multiplied by share in the associate 20% for calculating the amount to be added to the carrying amount of investment. And next year, or whenever the dividend will be paid by the associate and received by the investor, we are going to reduce the carrying amount of the investment by 10% of 50,000. So only for proposed dividend, do not adjust the carrying amount. Take the profit figure of the associate before making provision for proposed dividend, because the dividend has not yet been paid, so their net asset has not yet been reduced. Now the next is something very important. Write down important. Investor share of loss of an associate equals or exceeds the carrying amount. Suppose cost of acquisition is 1 lakh, and after the acquisition, post acquisition, the associate suffers losses. So I will have to reduce carrying amount of investment, less share of loss of associate. Suppose the associate has incurred loss of 10 lakh and our share is 20%. So mathematically it will come to 2 lakh. But we are equity holder. We are equity shareholder. Our loss cannot exceed the investment made. At the most, what we are going to lose? We are going to lose whatever investment we have made, because we are equity holder. We are not bound to pay more than that. So the standard says, if your share of loss exceeds the carrying amount, if the share of loss equals or exceeds the carrying amount, the investor ordinarily discontinues recognizing its share of further losses and the investment is reported at nil value. So investment will be shown at nil value. This is first rule. General rule is that if your share of loss exceeds the carrying amount, show the investment at nil value. Show the investment at nil value. But there is an exception to that. Exception. Next point is exception. Additional losses are provided for. This means our additional loss means 1 lakh will be provided for to the extent the investor has incurred obligation or made payment on behalf of the associate to satisfy the obligation of the associate that the investor has guaranteed or to which the investor is otherwise committed. Oh my God, such a long statement. It means that you will show negative balance only if there is an obligation. Only if there is an obligation. That means you have undertaken an obligation or you have given a guarantee on behalf of the associate. So if you are committed to pay for these losses either in the form of guarantee or any other way, then in that case additional losses will be provided. Otherwise additional losses will not be provided if the investor does not have any obligation, does not make any payment on behalf of the associate, or has not given any guarantee. So what the student will assume? Student will assume this part. Whenever your answer is coming negative, you will show at nil value. But if the problem specifically says investor has given guarantee on behalf of associate, to the extent of a certain amount, then that is the maximum loss you can show in the books. Okay. Suppose the guarantee was given only up to 50,000 rupees, then even though my answer is negative 1 lakh, outer column we are going to record only 50,000 to the extent the investor has incurred obligation. But they have never asked any question on this part. No question has ever been asked. No numerical question. Theory question is there in the book, but practical question has not been asked. So we are going to record it at nil amount only. Okay, this is second point. And the third point is, suppose later on the associate starts making profit. Remember our first year cost was 1 lakh, share in loss, continuously pay attention, share in loss 2 lakh, negative amount is 1 lakh, but we have disclosed nil value. Now I'll come to year 2. In year 2, my opening balance will be 0 because last year was 0. So carrying amount, opening balance 0, but they have started making profit. Add share in profit. Associate has made profit. How much profit they have made? Let us say 20 lakh into 20%, 4 lakh. But this 1 lakh loss we could not adjust earlier. So now I am going to first adjust the losses which were not deducted earlier, and then balance amount I will add. So 4 lakh minus 1 lakh, 3 lakh. Carrying amount at the end of year 2 would be 3 lakh. Now let us read, keep looking at the example. The investor resumes including its share of those profit only after its share of profit equals the share of net losses that have not been recognized. This 1 lakh was not recognized. So now if the associate starts making profit, first we are going to adjust that 1 lakh rupees loss, and then we are going to add it to the carrying amount. In our example, the loss which was not absorbed in the first year will be absorbed in the second year against the second year's profit, and balance 3 lakh will be added to the carrying amount of the investment. Okay, so these were the 3 points relating to losses of the associate. First, after deducting the loss, carrying amount should be not negative. You can make it nil, but additional loss will be provided if the investor has undertaken an obligation. If the associate subsequently reports profit, first adjust the previously unabsorbed loss and then start making addition to the carrying amount of investment. Next point, cumulative preference shares held outside the group. What is the meaning of this? Suppose associate has issued cumulative preference share. Cumulative preference share, as you all know, if dividend is not paid in 1 year, it will be accumulated and paid in the subsequent year. So the standard says, if you have cumulative preference share held outside the group, cumulative preference share issued by the associate held outside the group, means it is not held by the investor or its subsidiary. It is not held by the investor or its subsidiary. Then we are going to compute our share in the profit of the associate after deducting preference dividend for that year, whether dividend have been declared or not. So first you will make this adjustment and then multiplied by share in associate percentage. So this logic is applicable only for cumulative preference share, because in cumulative preference share, even if dividend is not declared, it will accumulate. So the liability has already accrued. The liability has accrued, only the payment is postponed. So therefore, the profit has to be computed after deducting the preference dividend liability which has already accrued. So this adjustment you will have to do even if preference dividend was not declared by the associate. But this is not applicable for non-cumulative preference share. Next is a very interesting question. If the associate also prepares CFS, let us say we have an investor. It has invested in an associate. This associate has a subsidiary. So what this associate will do? Associate will prepare consolidated financial statement. Okay. This investor will use consolidated financial statement for the purpose of applying equity method. Okay. Consolidated financial statement will be used. Consolidated financial statement of the associate will be used by the investor for the purpose of applying AS 23. So which means the subsidiary's profit will first get added to associate, and then consolidated profit of the associate will be used by the investor for the purpose of consolidation. On this we have only theory question. Good news, no practical question. So far no practical question on this. Otherwise you will have to first do this consolidation as per AS 21 and use that consolidated financial statement for the purpose of AS 23. So the institute also knows that this can be a little tricky exercise, and therefore they have not given any numerical question on this. Next point is paragraph number 16. Decline other than temporary in the value of investment. This paragraph is similar to AS 13. You can make a note, similar to AS 13. Okay. AS 13 is about accounting for investment. There also we have learnt if there is a decline in the value of investment other than temporary, then we'll make a reduction in the carrying amount of investment. Same thing here also. If you find that the value of the investment has declined, but it is not a temporary decline, it is a long-term decline, then you are going to reduce the carrying amount of investment. Then you are going to reduce the carrying amount of investment. So the same paragraph which was applicable for AS 13 is also applicable for AS 23. Carrying amount of the investment will be reduced if there is a decline other than temporary. One more good news. No practical question on this has ever been asked. Only theory question can be asked, multiple choice question can be asked. And now one important theory question. When is equity method not to be applied? Okay. Suppose you are holding more than 20% share in a company, but still you are not required to follow equity method. You are not required to apply AS 23. When is that allowed by the standard? Even though there may be another company where you are having a relationship of investor and associate, but the standard says don't worry, you don't have to apply equity method. Whatever we learned till now, till previous paragraph, was equity method. So for theory question, keep this in mind. Write down there, important theory question. When will AS23 or equity method not be applied even though there is an investor and associate relationship? First answer is, if investment is acquired and held exclusively with a view to its subsequent disposal in the near future. If the purpose of acquiring the investment is that it will be disposed in the near future, the standard says don't worry, then don't apply equity method. Then what will you apply? You continue to apply AS13. Continue to apply AS13. If you don't apply AS23 because your objective is to dispose in the near future, you are not interested in participating in financial and operating policy. You are looking for an exit, that the moment I get an opportunity to sell it, I'll sell it. Then why to apply AS23? So AS23 is basically when your objective is a long-term investment in associate. Okay, when your objective is a short-term investment, then there is no need to do such complex accounting. And second is the associate operates under severe long-term restriction that significantly impair its ability to transfer funds to the investor. Now let us say the associate is in a country like say Afghanistan. Your associate is a company located in Afghanistan. Afghanistan is taken over by suppose Taliban. Taliban has put a ban on outflow of funds. Nobody can remit funds to their home country. Nobody can take the funds out of Afghanistan. So now the associate cannot remit funds to the investor. In such case, equity method is not applied. First is objective is short-term investment, and second is associate comes under severe long-term restriction and it is not able to transfer funds to the investor. Again, very important paragraph theory question which you will find in the notes also at the end. You are applying equity method, you are following AS23, but then when will you discontinue? You were following earlier, but when will you discontinue applying equity method? Why would you discontinue applying equity method? From which date you will apply you will stop applying AS23? So the standard says an investor should discontinue the use of equity method from that day it ceases to have significant influence. The basis of the standard is investors should have significant influence. The basis of the standard is that investors should have significant influence. But if there is no significant influence, there is no need to follow AS23. The whole accounting standard revolves around this term significant influence of investor over associate. No significant influence, no application of AS23. So how is it possible? You might have sold the entire investment, or you may have sold some part of the investment, but now you don't have significant influence. For example, investor was holding 20% share. First possibility, it sold 20%. Second possibility, it sold 10%. Now if you have sold entire 20%, this is whole disposal. Now you are holding nothing. If you are holding nothing, there is no question of applying the standard. This is partial disposal. Now you are holding only 10%. But 10% does not give you significant influence. The third policy is you have purchased 40% more. So now your total holding becomes 20 plus 40, 20 plus 40, 60%. You will apply AS21 and you will discontinue AS23. You will discontinue AS23. So sometime an associate may become a subsidiary when the investor acquires more shares. So then you don't apply this standard, rather you apply AS21. Okay. So this is the first reason. You don't have significant influence. And the second reason for discontinuing is the use of equity method is no longer appropriate. You had an associate in Afghanistan, but now the associate operates under severe long-term restriction. So the associate has come under same reason. Initially it was peaceful. Afghanistan was peaceful. No problem. You were applying AS23, but suddenly Talibani took control of the government. They put a restriction on remittance of funds. Funds cannot be transferred from Afghanistan to India, and therefore now from this date onwards you will discontinue applying AS23. Okay, then what will you do if you discontinue applying AS23 and still if you are holding the investment, there is no complete disposal, you are still holding some investment, then you will follow AS13. You will follow AS13 for the investment which you are holding. And for this purpose, the carrying amount of the investment at that date will be regarded as cost thereafter. So whatever is the carrying amount on the date when you stopped applying AS23, that carrying amount will be deemed cost. That carrying amount will become deemed cost for consolidation purpose. In SFS, separate financial statement, you will follow AS13, but for consolidated financial statement, carrying amount of the investment, the date you discontinued applying AS23 will be treated as a deemed cost, will be treated as a deemed cost. Okay, one more good news, no practical question on this. Institute at intermediate level has kept it more simple, more theoretical, but when you will come to final level, that time you will have numerical questions where an associate becomes a subsidiary or a subsidiary becomes an associate or an associate increases the stake or decreases the stake. So how to handle those numerical questions is not right now in the scope of our work. So don't worry, they have never asked also, and there are no such questions in your study material also. Only for theory question you have to answer. What will you do when the investor loses significant influence? What happens when the associate comes under severe long-term restriction? So this kind of question will be asked. Now the next is different reporting date. Investor year-end date. Year-end date is 31st March 2025, and associates year-end date is, let us say, 31st December 2024. So this is called different reporting date. Now what are you supposed to do? First, associate will prepare its financial statement, but that is up to 31/12/24. Investor is preparing its financial statement on 31st March 25. So I cannot directly use this financial statement for the purpose of consolidation. So the standard has given a guideline. There is a gap of 3 months. In these 3 months, there would have been lot of transactions. Nobody is going to sit idle. So there will be transaction between 31/12/24 and 31st March 24. So the standard says adjustments are made for the effect of any significant event or transaction between the investor or its consolidated subsidiary and associate. So if there are significant transaction between these two dates which have taken place between the investor and associate, that occur between the date of associate financial statement and date of investor's consolidated financial statement. So the summary is that if there are difference in reporting date, adjustments will be made for significant event transaction that occur between the investor and the associate between these two dates. What about uniformity of accounting policy? Uniformity of accounting policy means investor and associate should follow same accounting policy for same kind of transactions, same kind of circumstances, so that when you are consolidating, the entire profits are based on same accounting policy. But practically, it may not be possible. Okay, you are an investor. There is an associate. You are only holding 20% share in associate. You are following FIFO method. Associate may be following weighted average method for inventory valuation. Investor would request associate, can you follow FIFO method? But the associate will say no. There are other shareholder holding 80%. They have asked me to follow weighted average method. So what do? I will take the financial statement of associate and I will make adjustments for difference in accounting policy. So I will recalculate the profit of associate as if they had followed FIFO method. So that adjustment will be done out of the books. Had they followed FIFO, how much would have been the profit? If suppose adjustment is also not possible, if adjustment is also not possible, associate may not give you enough detail to make adjustment, then only a disclosure is required in the note. So my first priority, uniform policy. Second priority, adjustment. Third option, if you can't fulfill the first two, make disclosure in the notes. Okay. Now we'll come to special points. As you already know, investment in associate is accounted using equity method. Point number 2, it will be classified as long-term investment. In the balance sheet, it will be classified as long-term investment and it will be disclosed separately in the consolidated balance sheet. It will be disclosed separately in the consolidated balance sheet as an investment in associate. Similarly, so in balance sheet, presentation is long-term investment, separate presentation. In P&L account also, our share in the profit of associate will be disclosed separately. In CF consolidated P&L account, our share in profit of the associate will be presented separately. And similarly, investor's share of any extraordinary or prior period item will be disclosed separately. What is extraordinary item? Refer AS5. Not ordinary item, not occurring, okay, in the normal course of activity, never planned by the management. Prior period item means error or omission of earlier year but discovered in the current year. So our share in extraordinary item, prior period item will also be disclosed separately. Now the next is disclosure requirement of AS23. Theory question. Disclosure requirement of AS23. Disclosures are given in the notes to account. First is disclose extent of holding in associate. That is, what is your percentage holding? Whether you are holding 30%, 40%, 20%, give disclosure. Second disclosure is if the proportion of ownership interest is different from the proportion of voting power. Ownership may be 35%, but voting power may be say 25%. Is it possible? Yes. Because there are two types of shares in India. One is shares with voting right, where one share is equal to one vote. Shares with voting rights. And the second is shares with, you will study in the law paper, differential voting rights, where you lose voting right but you get more dividend. So it is possible voting power may be less than ownership percentage. If that is the case, make disclosure. If that is the case, make the disclosure, and then name of those associate whose reporting data different from investor. This we discussed also. Plus you have to also mention what is the difference in the reporting date. How much is the difference? How much is the gap in the reporting date? And similarly, if the associate has followed different accounting policies, make disclosure. It will be classified as long-term investment. And also disclose share in contingent liability. In associate balance sheet, you have contingent liability. You will disclose your share in contingent liability. In the books of associate, you will have capital commitment. You will disclose your share in that capital commitment. Is it right? So this is about disclosure requirement under AS23. Okay. So now we'll take some questions. Please come to question number 1. You will find that we have prepared the answer for you. I would request you to give full attention on understanding part, and as a homework, solve in the notebook. As a homework, solve in the notebook. Is it right? So read question number 1. Read question number 1. Now we'll have take all the questions also in the class. Pay attention. X Limited acquires 20% equity share of A and 35% equity share of B at a cost of rupees 5 lakh and rupees 6 lakh 50,000 respectively. So for A you paid 5 lakh. For B you paid 6 lakh 50,000 and the stake acquired is 20 and 35%. Now they are saying the total accumulated share capital and reserve of the two companies were 32 lakh and 17 lakh respectively. So why this is given? Why this is given? This is given for computing goodwill or capital reserve on the date of acquisition. In case X Limited decides to prepare a consolidated balance sheet, they have to prepare consolidated balance sheet so that they can apply AS23. How the investment in A and B would appear therein? So investment would appear on the asset side as a long-term investment. It will be initially recorded at cost. Any goodwill or capital reserve will be included in the carrying amount, however will be disclosed separately also. Okay. So first what I'll do, first I will compute goodwill or capital reserve. So please follow me. How to compute goodwill or capital reserve? We have to compare cost of acquisition with the share in net asset of the associate on the date of acquisition. Cost of acquisition versus share in net asset. So cost of acquisition is 5 lakh for A, 6,50,000 for B, given in the first and second line. Point number B, equity of the associate on the date of acquisition. Equity means net asset, share capital and accumulated reserve. And good part is that 32 lakh and 17 lakh are given in the problem. Then what I'll do, I will not compare them directly. First I will compute percentage holding of X Limited. What is the percentage holding? In A Limited 20%, in B Limited 35%. So the student will take this calculator, multiply 32 lakh into 20%. That will give you share in the equity on the date of acquisition. 32 lakh into 20%, 6,40,000. 17 lakh into 35%, 5,95,000. Now I am going to ask you a question. Cost is 5 lakh. Reply first. Share in net asset is 640. Will you get goodwill or capital reserve in the first case? Cost is less, share in net asset is more. So this will give rise to, you mark here, capital reserve. Capital reserve. This will be capital reserve. Okay, because your share in net asset is more. Okay, try next one, B Limited. Cost is 6,50,000, but the share in net asset is less. You paid more. You paid more. So this will give rise to goodwill. This 55,000 is goodwill. So first task we'll do is to compute goodwill or capital reserve. And now the second task I have to do is to give disclosure in the balance sheet. These disclosures are applicable in CFS. This whole chapter is applicable if the entity is preparing consolidated financial statement. So disclosure is on the asset side, investment in A. Who is A? Your associate. How much is the cost? 5 lakh. But you have to write a note. It will include goodwill or capital reserve, but it will be disclosed separately. Includes capital reserve of rupees 1,40,000. And then investment in B Limited. Who is B? Again in bracket associate. Cost 6,50,000. And disclosure. This 6,50,000 includes goodwill of rupees 55,000. Is it right? So today we'll stop here. Thank you very much. Please revise the chapter completely today, and then in the next lecture we are going to take all the remaining questions. Thank you.